Module 3 Financial Products.
After understanding the concept of savings and banking, we need to understand what financial products are. Financial products acts as an investment avenue and provide the required financial security to the investors based on the risk-return profile of the financial products. In the past, traditional financial products were offered in India through government initiatives by public sector banks, PSBs, like Deposit Account, Credit Account, Life Insurance Corporation, LIC, and Postal Department, Recurring Deposit, National Saving Certificate, Kisan Vikas Patra. However, in recent years, with the advent of liberalization of financial service industry, diverse financial products have been introduced through participation of private and foreign entities in addition to the public sector enterprises. These include products such as debit and credit cards by banks, open-end and closed-end mutual funds schemes, life and non-life insurance schemes. It further includes shares and debt securities provided by various entities, investments which are mainly facilitated by the brokerage houses. Let us see some of the major financial products being offered in India. Number 1. Savings bank account. I have already explained to you about it. However, some of the features of the saving bank's account include: Number 1. Return. Banks usually provide 3 to 5% per annum. This rate can change from time to time. Number 2. Risk. Minimum risk. Your money is safe in a bank account. Even if somehow the bank gets robbed, you will get your money as the government guarantees investments in the banks up to rupees 1 lakh, and banks also insure themselves. Number 3. Liquidity. Very liquid. You can withdraw any amount up to the total balance in your account anytime during bank hours. Number 4. Tenure. No fixed tenure. You can keep your money in the account as long as you wish. This could be for years together, or you could withdraw it the day after you deposit it. Number 5. Taxes. The money that you receive as interest on your balance in the savings bank account gets added to your other taxable income and is taxed at the rate of tax applicable to you. Short-term savings products. If you wish to invest your money for short periods of time, there are various financial products available. Some of the popular ones are bank fixed deposits. Bank fixed deposits are similar to a saving account. The money invested under the bank fixed deposit is kept in the bank for a fixed period of time that you decide at the time of investing. The period can be a few months, a year, or a few years. The interest you receive in a bank fixed deposit is higher than that offered on a savings bank account. The rate of interest varies slightly from bank to bank. Recurring deposits. Recurring deposits are a special kind of term deposits offered by banks and post offices in India. Unlike a bank fixed deposit, you do not have to deposit a lump sum principal amount, but can deposit a fixed amount at a regular interval. For example, you can deposit rupees 500 every month for 3 years. At the end of 3 years, you will receive not just the amount that you invested over the years, but the interest as well.
Arvind ji, can we avail these facilities as soon as we have our personal savings bank account in the bank?
Yes, you can, Vidya. Number 3. Long-term investment products. You need short-term savings products to match your short-term goals. We also use short-term savings products to keep your money safe when a long-term goal is fast approaching and you have saved up enough to achieve it. However, when you begin planning for a long-term goal, you need long-term investment products to help your money grow. Some of the long-term investment products are listed below. Post office savings schemes. Post office schemes are also called small savings schemes. These are designed to provide safe and attractive investment options to the public and at the same time to mobilize resources for the postal department. Some of the popular financial products offered by the post office are listed below. Number 1. Post office savings accounts. These accounts are very popular as they can be opened in any post office in India with a minimum of Rs 20. On the outer limit, a maximum of Rs 1 lakh can be deposited per single holder and Rs 2 lakhs for joint holders. Number 2. Post office fixed deposit accounts. These deposits can be compared to bank fixed deposits and like the post office savings accounts, they can be opened at any post office in India. The depositor is provided with a passbook with entries of the deposited amount and other particulars duly stamped by the post office. Number 3. National Savings Certificate. The National Savings Certificates are available in values of Rs 100, Rs 500, Rs 1000, Rs 5000 and Rs 10,000. There is no maximum limit for purchase of these certificates. The period of maturity of a certificate is 6 years. At the end of 6 years, the principal along with the maturity amount is given to the depositor. Number 4. Kisan Vikas Patra. It is a savings scheme that doubles the money invested in 8 years and 7 months. Any individual can safely invest and save their money in the form of Kisan Vikas Patra. They can be purchased in all the post offices across the country. Number 5. Public Provident Fund, that is PPF. PPF account can be opened at certain designated post offices throughout the country and at certain designated branches of public sector banks throughout the country. The account matures after 15 years. It can be continued with or without subscriptions after a block of 5 years. A minimum deposit of Rs 500 per financial year is required and the maximum deposit limit is Rs 70,000 in a financial year.
Arvind ji, I feel bad that I did not understand the importance of having a bank account earlier. And also, I did not know about the vast number of facilities available through post office as well. I wish I had known about this earlier.
Ram, do not feel bad. There are many people like you in your village and other areas who lack the knowledge of the above. Do not worry. You can start now and spread this knowledge that you have gained to your relatives and peer group as well.
We sure will.
You also need to know about insurance and pension, but I'll explain about them later. As of now, it's important for both of you to know that you need to be very careful before investing. Let me explain. Cautions while investing. While there are many options to invest, you need to be aware that there are recognized, legitimate financial products as well as fake ones too. The genuine ones give you returns based on how they use the money you invest. For example, when you lend your money to a bank for a fixed period of time, the bank further lends that money to someone else. The rates that banks offer and the charge are fixed by the Reserve Bank of India, RBI, and the banking system, and your money is very safe with them. The case is similar in case of post office savings and other recognized organizations. However, you should be careful about investing in schemes offered by people or organizations that are not recognized by a regulator like RBI, SEBI, IRDA, etc. The schemes promoted by unrecognized companies may look very attractive when you first hear about them. Some of the examples of such fake financial investment schemes are chit funds, tea plantation schemes, etc. The main indication to know if it's a fake or legitimate financial product is to see if the return seems to be too good to be true. You should ask a lot of questions about the scheme and consult people whose financial knowledge you trust before investing. If you invest in such a scheme, it can wipe out years of efforts that you or your loved ones would have made to save that money. So, be careful. Don't be greedy when it comes to investing. There are no shortcuts to investing. Always be patient.
Arvindji, we will definitely be careful and will consult you before investing.
Sure, Ram. I will be glad to help. Let me tell both of you about the right investment. The choice of the best saving and investment options will depend on personal circumstances as well as general market conditions. An investment for one objective may not suit the needs of the other. A right investment is a balance of three things: liquidity, safety, and return. Liquidity. This will cover the ease with which the investment can be covered to cash to meet expenses. Some liquid investments are required to meet exigencies that arise in the normal course or otherwise. Safety. This is about the risk factor of the investment. The worst case is losing all the invested money. The milder case is losing on the income or low income growth or investment growth. Inflation is also a risk as the purchasing value of money reduces. Return. Income generated by investments is another factor to consider. Safe investments offer steady but lower income, and risky investments offer high returns or no returns at all. There are several short-term and long-term financial investment options available. Thus, there is a staggering variety of investments to choose from. I will share about it with you later. It's late now. I better leave. Let's continue the discussion later.
Arvindji, you are being so kind to us. Thank you for sparing your valuable time to give us such wonderful information about the different financial aspects.
I am quite excited to open our savings bank account. When we meet you next, could you please tell us how do we operate our bank account?
Sure, Vidya. I will definitely talk about it the next time we meet.
Please work on exercise 6 in your handbook.